Hello, hello. Dylan Lange, branch manager, home loan officer at Evergreen Home Loans, and happy May. This is the April mortgage update. I know I'm a little bit tardy. Shame on me. I took my first kind of pseudo vacation of the year. We were in Hawaii and Palm Springs the last week, so I'm a little bit behind. I was in Hawaii for a work trip. They do something called President's Club every year. If you're top 15% as a producer, you get to go, bring your significant other, stay at the Four Seasons in Kona. It was incredible. So this is not a spray tan. This is a real tan. And yes, my whole back is peeled off and probably on my shirt right now. But had an amazing time. Some nice R&R that we needed. And just huge thank you if you're a referral partner, business partner, if you're a past client, you're watching this is all because of you guys. Really appreciate your trust and trusting me to help you with your biggest purchase of your life. So anyway, let's jump into the April mortgage update. What we're going to talk about today is the turn down loans into turn up. Turn up because we're so excited. We got them closed. I'm going to talk about a few different scenarios I've come across this year where these would typically be turn down loans. These clients would not qualify in a conventional loan, but we've got some unique products that we've been able to get them approved, get them into a home, and then they will most likely refinance down the line. So first off, before I jump into that, remember WelcomeHomeLoans.com is my website. Up here in resources has all the prior videos. It has a bunch of, I always have to show my NMLS number in this video. This is a totally redesigned website, has all of my information, our stats that we had last year, testimonials and reviews, all that good stuff. Feel free to share that with your friends, family, coworkers, anyone looking to buy or sell real estate. Would be honored to help them. So instead of me blabbing, let's jump into it. So my quick nugget, as I said, how to turn a turn down into a turn up, how to turn a turn down loan into an actual closing. So three main types that I have been doing recently. One is a DSCR loan, a debt service coverage ratio loan. One is a bank statement loan. And then one is asset depletion. That's the third one. Okay. DSCR is debt service coverage ratio. This is for when somebody wants to buy an investment property. And then I had one where the gentleman lives up in Canada, has a dual citizenship. He couldn't buy an investment property here because he doesn't live here. So we're able to do a DSCR loan. I've had other ones where maybe people didn't have the income to support the debt load. And so we're able to do a debt service coverage ratio loan. What that means is we just look at the proposed rent or the current rent on the property. As long as that covers 80 to 100% plus of that interest-only mortgage payment, then they'll qualify. You do need a good credit score. You need a down payment, right? You can't come in with, $500 down and a 250 credit score, right? You do need a credit score. You do need the down payment. If you do 20 to 30% down, then the proposed rent or current rent needs to cover at least 100% of the interest-only payment. So that would be interest-only plus taxes and insurance and any HOA dues or anything like that. Okay. If you do 30% down or more, it only needs to cover 80%. So that's how that works. There's a calculation that we do. Let me know if you have any questions about that one. It's a very, very popular loan. You can do it in a refinance. You can do it as a purchase. But I've had two clients now year to date that have used this program for one reason or another. The second one is a bank statement loan. So I've had a lot of self-employed borrowers typically that have, they have a paper loss on their business, right? They write off a lot of expenses. Maybe they had a big purchase. Maybe they had a higher expense year and we're not able to qualify them. They can do this for a primary, second investment, anything like that. And then we are able to look at their business bank statements for the last 12 to 24 months or personal bank statements, and we look at the deposit. So really, we just look at the revenue, and then we do a cash flow analysis on that. There is a calculation that we use, but then we don't have to, if a client, their revenue is $250,000 and they write off $200,000 on their taxes, their taxable income is $50,000. On a conventional loan, that's the only income I can use. On a bank statement loan, we look at that $250,000 gross receipts, and we do a cash flow analysis on that. We take a smaller percentage for expenses and give them credit for that income. So awesome program, helps people qualify that potentially have a paper loss on their business. And then the third one that I've been doing a lot of is asset depletion. So Fannie Mae, Freddie Mac, the biggest GSEs, conventional loans, they do allow this, but you have to divide the assets by either 240 months or 360 months. So even if you have $1 million in there, it's not that much for income. And this has to be the leftover asset. So if they have $1 million, use 500,000 for their down payment. We only have 500,000 left. So on another one of our correspondent or broker options, we take that same amount, same thing, right? If you have $1 million, you spend 500,000, we take the 500,000, we divide it by 84 months, right? So let's just look at the difference there. I'm going to do a calculator because I don't know this by heart. So $1 million, let's just say they have $1 million left over in their account. I know I said 500 earlier. They have $1 million divided by 360. They get credit for $2,700 a month in income. It's not very much. $1 million divided by 84 months, they get $11,904 a month for income, right? Huge difference. Also, one of my correspondent options, typically on Fannie and Freddie, you have to be of retirement age or older, 59 and a half. On this option that I have, you can be under retirement age. So I had a wonderful gal that was under retirement age, had assets, didn't have income. We were able to use the assets, divide it by 84, create income for her so she was able to buy a house. So don't forget those three: DSCR, bank statement loan, asset depletion. There's many, many more, many guidelines, many variances. I don't want to go through all of those to bore you on this, but just remember those three. If you have any friends, family, coworkers that have maybe been turned down or denied and may fit into this bucket, or clients, please let me know. Reach out and I'd be happy to talk through it. All right, rates. Oh my gosh. Let's pull over to here. So Mortgage Market Guide, as you guys know, is a huge, I follow them religiously. Bill Bobner's, smarter than I will ever be. So the Fed met, it was Wednesday, right? It's Friday right now. We were freaked out, right? We thought rates were going to keep skyrocketing. If we go down here and look at this candlestick bond market pricing, we've had this kind of downturn the last month and a half. Look at this. After the Fed met, we've had these 3 green candlesticks, which is great for mortgage and mortgage pricing. So mortgage rates, although they were on the incline, they're now starting to decline a little bit. Once again, just a volatile market. Okay. There's no way to predict where these are going to go. Everyone thought the Fed was going to come out, talk hawkish, higher rates for longer. Inflation hasn't come down enough. And then they come out and they're not as hawkish. And suddenly rates are starting to come down. So if you look here, you've got your interest rates on the left, so 6.99%. And I run these at a 700 purchase price, 700,000, 10% down, good credit, primary, single family, all that good stuff. It's all here. But a 6.99 would cost you a point. So 1 point is 1%. If your loan amount is, $630,000, like this example, it'd be $6,300 for this rate, right? 2 points would be double that, right? So it'd be 12,600. So any questions on that, reach out to me. Once again, these are all over the place. And I've put, mortgage rate trend was really up, but it's starting to kind of teeter back down. And then the mortgage application trend, you'll see here, has been down the last few weeks. Once again, highly, highly, highly connected to interest rates. So if you're a buyer that's been sitting on the sidelines, now might be a good time to jump in before these rates start to turn, and then you'll have a refinance opportunity later on. Internal turn times, appraisal turn times, I'm closing loans in 2 weeks. So, to be highly, highly competitive, we are in a low inventory market. If you need to be competitive, we can do a quick close, get in to get pre-underwritten, get your ducks in a row. I also just saw some stats the other day that, my market is Whatcom County, specifically, Bellingham and surrounding cities. I saw this really interesting stat because I have, a lot of clients that come to me and say, I want to buy a home in Bellingham, core neighborhood for $500,000 to $600,000. Great. Here's the challenge. The median closed price in April was $715,000 in Bellingham and $635,000 in all of Whatcom County. So let's take that. It's some important stats to know. I believe that's all we've got for you this month. Once again, please do subscribe to this channel. You'll see, different mortgage videos that I do, different loan programs, and also check out WhatcomHomeLoans.com for all of the other resources. And I will catch you next month. See ya.